You clicked on this video because you want to understand bonds. You likely believe they are the safe harbor that protects your portfolio when stocks crash. But here is the hard truth, that safety is an illusion that can vanish instantly. The real stakes involve your capital evaporating during the very inflationary cycles where you need protection the most. By the end of this video, you will understand why bonds can fail as capital protectors and how duration risk turns them into volatility amplifiers. For decades, the financial narrative has taught us that bonds are the opposite of stocks. When equities tumble, bonds rise, creating a perfect hedge. This logic suggests that holding a mix of both guarantees safety, but this view relies entirely on a historical artifact, a low volatility environment where interest rates remained stable or fell. When the economic landscape shifts, that inverse relationship breaks down, and the mechanism that was supposed to save you becomes the very thing that hurts you. To understand why this happens, we must first look at the fundamental mechanic of bond pricing. Investopedia defines bonds as fixed income loans where prices move inversely to interest rates. This is the bedrock of the bond market. When interest rates rise, existing bonds with lower coupon rates become less attractive. Their market price must fall to match the new higher yields available in the market. This inverse relationship is the mechanical basis for their role as volatility dampeners, but it also contains the seed of their failure. This brings us to the critical concept of duration risk. Duration is not just a number on a spreadsheet. It is a measure of sensitivity that acts as a leveraged bet on interest rate changes. A 10-year bond has roughly 10 times the sensitivity to rate shifts compared to a 1-year bond. This means the safety of the principal is illusory if your holding period is shorter than the duration of the bond in a rising rate environment. If you hold a 10-year bond and rates jump, your portfolio takes a hit equivalent to a 10% drop for every 1% rise in rates. Consider the specific conditions where bonds fail to protect capital. During inflationary cycles or tightening monetary policy, central banks raise rates to cool the economy. In these moments, the duration risk is amplified. The bond market does not wait for inflation to settle, it prices in the future immediately. As a result, bond prices drop sharply. This dynamic challenges the safe narrative because bonds can suffer significant drawdowns similar to equities when interest rate shocks occur. You are not just waiting for coupon payments, you are watching the value of your principal erode in real time. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The fear that their safe diversification strategy is actually amplifying losses stems from this exact mechanism. In a high-inflation environment, the real return on bonds becomes negative, while duration risk exposes the portfolio to significant nominal losses. The asset class that was supposed to dampen volatility instead becomes a volatility amplifier. This is not a rare anomaly. It is a structural feature of fixed income that most investors overlook because they are focused on the coupon yield rather than the price sensitivity. Technical bond pricing models reveal that bond price volatility is nonlinear and heavily dependent on the specific duration profile of the portfolio. An AI-based predictor found in corporate bond price datasets shows that valuation is not static but highly sensitive to market sentiment and credit spreads. This means a safe bond can experience equity-like drawdowns if the yield curve steepens rapidly. The mathematical models confirm that the correlation between bond volatility and macroeconomic shocks is driven by the duration, not just the credit quality of the issuer. There is a specific threshold where bonds transition from diversifiers to correlated risk assets. This transition happens particularly in high inflation environments where the central bank is aggressively hiking rates. During these periods, the flight to quality trade often fails to materialize because the rising rates drag down prices across the entire spectrum. Even as the underlying credit quality of the issuer improves, the duration risk forces prices lower. The safety label for bonds is a historical artifact of low volatility regimes that no longer applies universally. Think of duration as a magnifying glass for interest rate movements. If you have a short duration bond, a rate hike is a small bump. If you have a long duration bond, that same rate hike is a cliff. The difference lies in the leverage inherent in the duration. A 10-year bond has roughly 10 times the sensitivity to rate shifts compared to a 1-year bond. This is why a 10-year bond can suffer a 10% loss in a single year of rising rates, while a 1-year bond might barely move. The safety of the principal is conditional on the timing of your exit relative to the interest rate cycle. The misconception that bonds are always safe ignores the mechanical reality of the inverse price-yield relationship. When rates rise, bond prices fall. This is not a bug, it is the feature that allows bonds to provide income. But it is also the feature that causes capital erosion during tightening cycles. Unlike stocks where volatility is often driven by sentiment, bond volatility is mechanically driven by the inverse relationship between yield and price. This makes the dampening effect conditional on the correlation between the bond's duration and the macroeconomic shock causing the rate hike. Practitioners must recognize that while bonds historically reduced portfolio variance, this protection is conditional on stable rate environments. The evidence suggests that viewing bonds solely as safety is a misconception. They are better understood as a tool that manages volatility through duration, provided the investor accepts the inherent risk of capital erosion when rates rise. You are not buying a safety deposit box, you are entering a contract that is sensitive to the cost of money. The key insight you need to take away is that the safety of bonds is not a property of the asset itself, but a property of the economic regime. In a falling or stable rate environment, duration acts as a stabilizer. In a rising rate environment, duration acts as a lever that magnifies losses. This means that your diversification strategy must account for the duration profile of your holdings, not just the asset class label. If you hold long-duration bonds during a rate hike, you are effectively betting that rates will fall, and you are wrong. Understanding this distinction changes how you view your portfolio. It moves you from a passive acceptance of the safe label to an active management of duration risk. You must ask yourself what your exposure looks like if rates rise by 2 or 3%. The answer will determine whether your bonds are your shield or your sword. The market will not wait for you to adjust. The price will adjust the moment the rate hike begins, and your capital will be the casualty if you are unprepared. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.